So that will lead us very nicely into the next question we have. Can Singaporean corporates benefit from China's Belt and Road Initiative? Again, the answer yes or no. 10 seconds. Okay, well, thank you very much for that. Now we're going to start our panel discussion. We have 25 minutes, and next for the last 5 minutes, we'll actually open it up to the floor, and so you get to ask, your question and how, everyone seems to be very optimistic about Asia. Do you think then perhaps the markets are being too complacent about the leverage risk in China?
Well, I think it's been so well flagged for so long, and we've gone through a few bursts of panic about this over the last several years. So we're now at the stage where people know that there's more problems to come, that there's a lot more bad debt that needs to be recognized. We don't know how bad the evergreening of bad debt is, i.e. turning interest payments from zombie companies into principal, and that adding to this inefficient sort of credit growth that we've been talking about earlier. That's why we like to look at simple metrics, the bang for your buck of, say, credit growth minus GDP growth. On a longer term average, it's still 7 percentage points faster credit growth than nominal GDP growth. So it is improving in that, say, this year, corporate sector debt as a ratio to GDP by our estimates is flat, but the overall ratio is still rising. And I think the only reason that people are a bit more confident now, as we were, I think, for a bit longer, because we thought, well, how can this play out in an economy like China? And I think it's about what the differences are between there and elsewhere. And the biggest one of all is the concentration of where this bad debt lies is ultimately, it was created by a deliberate policy action of using lending by state-owned enterprises, state-owned banks to state-owned enterprises. Therefore, alongside local government debt, which, to be fair, has been worsening again, with the importance placed on GDP growth targets, at least out to 2020, the problem probably gets slightly worse rather than better. But I think that's why they're attacking systemic risk. For example, issues to do with the financial sector lending to itself. That tightening up there that we've seen since the end of last year is reducing risk, and it's showing that they're not asleep at the wheel. This is not 2007, where you still are seeing policymakers talking about the need to hike policy rates because they're just focusing on the wrong things, as we saw in the West. I don't think you have that problem in China, and they do have enough hands on enough levers to be able to deal with anything systemic as it comes along. We think they've got the net asset position to be able to deal with that. But is it something that is still a concern and will become a bigger challenge? Yes. And that's why whenever you get a panic, as we saw with the sensitivity that everyone agrees is higher for everyone in the region to China than to the US, any panic about a collapse in growth in China means game over for world growth and also for expectations on growth in this region. So it's a huge impact potential event that is not yet materialized, but we have to keep that front and center as a risk.
Okay, Marie, the Chinese GDP has held up actually quite well. According to the Institute of International Finance, this helped the debt GDP ratio in China to actually dip by 2%. With GDP growth holding up and corporate leverage flattening out, have risk in China disappeared?
Yes. So I think what we have seen over the last year or so is a clear, again, confirmation of the importance of growth in terms of policy objectives in China. So there's been significant stimulus provided to this economy, support to this economy to maintain growth at around, let's call it 6.5% or thereabout. And that objective has been achieved, which is positive, said, in that the economy is responding to that stimulus. In the process, what we've seen through excess capacity cuts is prices have increased, and that has helped then these corporate leverage ratios to come down slightly. The other aspect that I think is positive, and I would add to David's, is that China's capital account is closed. And so that financing of that debt stays in China. So there are very large savings in China that are used, they're channeled through state-owned banks to finance debt of state-owned companies. So all of that can continue for a long time. And so I think the risks that we're looking at are slow burning risks. And the risk will go through periods of relatively higher growth, relatively lower growth. That noise is not indicative of really a change in direction of risk. What will matter then is what we were talking about earlier, the allocation of capital, the qualitative allocation of capital, and the management of the risk in the shadow banking and the formal banking system. And here I think it's still early days. Where the authorities have certainly kind of become increasingly aware of these risks and are addressing trying to address some of the issues. The implementation is very, very complex because it involves everyone. It involves the banks, it involves the shadow banks, it involves the local government as well. And aligning the objectives around all these levels is very difficult.
You know, Carlos, I'm going to bring you in this conversation. Earlier you gave an interview with CNBC and you spoke about the China price pressures. You know, why don't you share with us a little bit of what you spoke about this morning?
Hi, good evening, everyone. So in line with the point on growth and GDP, we have seen a trend in the past months to try to deflate that level of debt. Nominal GDP is actually quite high, is around 11% in the past quarter, and that's helped to curtail those levels of debt slightly. However, you have to understand that nominal GDP is real GDP corrected for inflation, and most of the inflationary pressures, or that reflationary story in China, are not necessarily related to consumer inflation. In fact, consumer inflation remains significantly below target. Their target for this year was 3%. And we've seen CPI, I have a slide on that later, reach only 1.5% year to date so far. So most of that story is surrounding producer price inflation. And most of what's driving up producer price inflation is recovery in metal prices. So we are a little bit concerned surrounding that sustainability of that recovery and whether it will enable the authorities to continue to stabilize debt through growth.
Okay, you know, I'll just bring everybody into this discussion now. You know, China has announced, let's talk about the Belt and Road Initiative here. China has announced a series of initiatives to boost inter-regional cooperation. Do you think China is going to displace America in APEC?
Yeah. I think China will play a different role from what the role that the US has played in APAC. So Belt and Road, for instance, is an example. The US never attempted to build a Belt and Road. What we are seeing now currently is that Belt and Road is a label, is an umbrella really to describe investment in China all the way from here to pretty much to Europe, and it's progressing at different paces. It's progressing more rapidly in some countries, like in Pakistan, with a corridor being built, where we're already seeing investment happening, and progressing probably more slowly in other places, in particular when we go towards Central Asia. The objective here for China are probably multiple. They include objectives around maybe using some of that excess capacity. It's really the Belt and Road is providing outlets for that excess capacity. Securing energy and food security is very important as well as the contributing to the internationalization of the RMB. And so what we have seen is an increase in the number of swap lines between China and various countries, and through the Belt and Road, some the payments will probably increasingly be done in RMB, and that will contribute to that. Overall, it is likely to benefit China to the extent that it can help with the excess capacity aspects. It's likely to benefit the host countries as well. We are seeing tensions, and Pakistan is an example where the investment then necessitates very significant imports, and Pakistan doesn't necessarily have the capacity to really significantly increase its imports. So we are seeing some pockets of stress there. And for China, I think the difficulties will be to manage the risk in what are very challenging investment conditions.
Well, yeah, and I think the ultimate example of that is in Venezuela, where a lot of projects have, taken place, and there's a lot of debt to be serviced. But I think, firstly, the point that we get asked a lot about on this subject is whether or not there'll be some boom in Belt and Road related initiatives next year, now that Xi Jinping has increased his grip on power, and it's his project. And certainly, I believe very firmly that he really wants to see it do very well. But at the same time, we have to take into account how the capital account challenges have been acute over the last few years, and they only just recently, in the last, say, 6 months, have we seen some better performance in terms of more stable capital flows, partly because of a tightening up, reversing some of what was seen to actually achieve SDR status. So now we're at a stage where we will see more Belt and Road initiatives, but it will probably be more of the places that have already been receiving it, though even in some cases there are places that are starting to get more wary of it. But it will not be across the board. We don't see huge progress, for example, in Thailand or in other parts of ASEAN, outside perhaps of Malaysia, where we have seen some good flows. But in general, I don't think you're going to see an explosion of outward direct investment next year. And I agree, it's just an umbrella term now for almost anything that's outward direct investment that China's doing. It's been going on for a long time, and I think a lot of these strategic concerns, such as China's lack of clean water, which means effectively, okay, let's import effectively water from outside. That's why soybeans come in to such a degree from, say, parts of Latin America. That relationship just wasn't there to any significant degree 10 plus years ago, and suddenly it became such a critical trading partner for that region. So these linkages, I feel, were inevitable because it just makes sense for China, but don't expect some big bang to come next year.
Okay, but the voting here, 65%, everyone here, believes that, we can benefit from the Belt and Road. Do you think it's a misplaced, perhaps, optimism here, Carlos?
No, I agree with what the speakers have been saying, but one of the other goals of the initiative, which we didn't mention, is creating markets for Chinese products overseas. And so any initiative that aims or targets to reduce the cost of transportation will benefit China, and in this case, Europe as well, because remember, Belt and Road connects China with Europe, ultimately. So it will benefit both parties at perhaps the expense of the United States, because it will be faster and better and cheaper trade. However, it is a very long-term initiative. There are political risks that are quite important and have to be considered when implementing these projects. The railroad crossing Pakistan in order to facilitate oil imports into China without going through the Malacca Strait, which I think is a very relevant topic here in Singapore, is in theory very good. In practice, it's very hard to implement. Of course, on top of political risks, we have a financing issue. So the infrastructure investment gap in the region is huge. The ADB places that amount at about $8 billion US per year between now and 2020 or 2030. I'm not sure about the specific date. But China's set a floor on its FX reserves, an informal floor on its FX reserves at 3 trillion in order to stabilize those capital outflows. So it cannot afford to splurge on vanity projects everywhere. And so in order for this initiative to materialize fully, you need more participation from the private sector. And these projects need to be financially viable in order for the private sector to participate in the initiative and to have companies on board as well, securing those payments. And there's not that many of those outside of some of the countries that we've already mentioned, Malaysia being a great example, Thailand and Indonesia being other good examples.
Sri Lanka.
And Sri Lanka.
But this is a challenge, that the places we've seen it take place, that's fine. But a lot of other places where we discuss, can they get even their own infrastructure projects delivered? If you're not even seeing spending being done of their own budgets in various countries, why will you see suddenly an outsider being able to get things done? Even an outsider that's able to get things done so very efficiently inside their own market, it's much harder outside. And I think that learning process has been what China's been going through for the last 4 years already. But the fact is that actually a lot of people kept coming up to me saying, oh, this new Belt and Road Initiative, what do you think it could mean? At the time of the 4-year anniversary of the conference this year. So really, it's not got as much traction in many areas as it could have done. I think it could get a bit more, but all these challenges are going to be very tough to actually get over.
Well, speaking of the conference, Mary, that just concluded. Do you think the government, the Chinese government specifically, do you think they're going to prioritize growth at the expense of reform?
It will be a combination, and I think a year or so ago we liked it. We still think it is very relevant to describe really the policy choices in China as a trilemma. There is growth, which is very much an objective. There is reform, that is there too, and there is stability, and all three are related. Stability is probably, if they have to prioritize between the three, stability is probably the key one. It is economic stability, financial stability to deliver social stability. And so that, again, talking about floor, that probably puts a floor on really minimum growth levels that the authorities are ready to tolerate. And so once that's secure, then reforms can happen. I think we've seen that over the last few years. Growth has been relatively strong. That has opened the window for reforms at a gradual pace, really, to maintain that growth and stability.
You talked a lot about China, the Belt and Road, but the other thing as well that is also very much happening and we've been seeing is populism and how that also comes hand in hand with protectionism. You mentioned there about what's happening in the world today. We're seeing what's happening in Brexit. Not to mention what's happening in America as well. Carlos, I want to bring you into this conversation. What should companies do then to mitigate trade risk in what we're perhaps maybe seeing as an increasingly protectionist world?
So while I fully agree with some of the points that the speakers and our CEO Xavier made earlier, that there has been an increase in the protectionist rhetoric that we've seen in the world, so far that's been mostly contained to words. So other than the US pulling out of TPP, we haven't seen them implement like a tax over the board for all of their imports, which was a very significant risk concern. And they've also not embarked in a full-fledged trade war with China, which was the other potential black swan event that we were looking at last year, right? So in a sense, like the risks of rising protectionism have mitigated. And a number of signatories to TPP are meeting in Vietnam now to discuss ways to revive that agreement. But it's not, the risks of protectionism is not over yet. And actually, Christine Lagarde was out yesterday ahead of those APEC talks in Vietnam, commenting that while we haven't seen a translation of full materialization of protectionist risks, if they were to happen, Asia would be the region that would suffer the most from those risks. So there's been an increase in rhetoric, and that's translated into an increase in policy uncertainty surrounding protectionism. And I think, given that uncertain environment, the best way to protect yourself against this increase in protectionism is to do things like monitor the risk in those countries, and we do that on a daily basis for the main countries in Asia and other parts of the world. Of course, if secure your receivables, purchasing trade credit insurance can help. To at least shift some of that responsibility onto a third party, such as Coface. And trust me, if we believe that you shouldn't be doing business with a partner, we will also consult and inform you about that process. And just being sensible about how you do business, who you do business with, and if you're seeking growth and you're trying to expand into new frontiers with unknown partners, to try to do the due diligence and understand what the political risk for the country and what the risks for that sector in the country are.
Yeah, I think it's important to note, though, while we've not seen some of those more extreme actions, and certainly if you just follow the actions, you can feel a lot calmer, as I think we're all agreed on that front. There's been a trend in the last 15 years of rising amounts of restrictive measures all around the world and more actions in WTO. And the fact is that the Doha round completely died out, and we're trying to resuscitate now. TPP, RCEP could go through. Something positive might happen on that front, but that challenge of we already expanded global supply chains, the whole intermediate goods trade, the surge in global trade as a ratio to global GDP growth ended. I don't think we're going to see a collapse from this point at all, and I doubt that you'll see extreme measures and trade wars being taken. I get actually more worried about, one, this slow burning, multiple cuts to global trade instead of one big blow, but also on top of that, technological change impacting the actual necessity of all these supply chains. Why not produce even more using technology, 3D printing, automation, taking away some of the development opportunities of many markets that were expecting to be able able to grow through low-cost labor-led manufacturing. I think that's potentially a bigger problem that could be created from technology in the future. That could lead to even more of these social issues and then forces even more protectionism.
Yeah, and it will be a mix of active protectionist measures. And I agree, there's been an increase in non-trade barriers really throughout the last decade or decade and a half. And a mix of maybe companies themselves really questioning some of their kind of supply chain involvement and relocating production maybe closer to home, thanks to technology or for other reasons. And the rhetoric is happening. The rhetoric is really responding to, I think, popular demands that we're seeing the world over. So we do assume that this is a structural change. The days of global trade volumes growing by 6-7% per year every year are probably behind us. We've seen a pickup recently. We think this is probably as strong as it might be for some time, and so on a trend basis, we don't expect that to return really back to the pre-global financial crisis days.
Right. Well, I'm going to open it up now to the floor. So if you have any questions, raise your hand, and the usher will bring the mic to you. And if you could just, give me your name, company, the question, and who you want that question answered, and who that question is for, would be most helpful. So we have a couple of minutes now. Do we have anybody? Do we have a question? You can raise your hands. You don't have to be shy. Okay, so why don't we discuss a little bit more then? Okay, David, I want to talk about you discuss the monetary conditions in Asia. So, tell us more about the implications of the U.S. policies for the region. We're talking so much about China. We haven't really mentioned a lot about the U.S. Do you think what are some of the scenarios that will come into mind? And do you think, in that sense, then which country is going to be most exposed?
Well, we've seen since the taper tantrum, and you look at studies that we've done on what the impact has been of, say, US policy shocks in the past, and Malaysia and Indonesia had, amongst emerging markets, are in the list alongside, say, Turkey or Brazil as being the most vulnerable in terms of their currencies being impacted by sudden US policy surprises. But the fact is, we've been pricing this in for a while. And I think we've seen a lot of the fact is actually that many of the currencies were able to adjust over the last several years without a crisis. And that's a nice change compared to, say, 97, if you'd seen as dramatic moves, and we did see some very significant moves in the Indian rupee, the Malaysian ringgit over the last several years. It didn't trigger a crisis. And one of the reasons is the external metrics that we look at. When you see the external debt ratios, there's now at least a decent portion that is not foreign currency denominated of the external debt exposure compared to, say, during the Asia crisis years, where literally all of the foreign external exposure was bank lending, short-term dollars, compared to long-term investors who own, say, local currency bonds, and these could be sovereign wealth funds or other central banks even, or pension funds, longer-term investors. That's the good news. But were you to see an aggressive rate hiking cycle, I would argue that those economies that have had to follow suit previously include, I would agree, say, Indonesia. And that's partly why, actually, even in the last year and a half, they've been able to actually adjust back down their policy tightness that they had on the monetary side, because they felt that much more comfortable about the financing of the current account deficit that they had. So if we go back to it, it's the same. The usual suspects would be on the list. It's just that we feel like we've already been through this process and we're coming out the other end.
Marie, how do geopolitical risks affect your sovereign outlook in the region?
Yeah, very, very good question. So political risk in general and geopolitical risk in particular is part of assessment. And what we think about is, what is the nature of the risk? So is it a conflict? Is that tensions between countries? What is the probability? What is the impact? And so we talked about North Korea and potential conflict on the Korean Peninsula. We have, as a result, observing really developments over the last year or so, we have raised our assessment of geopolitical risk for South Korea. So we rate South Korea at AA2. It's a very high rating. That rating embeds that geopolitical risk. So put another way, absent geopolitical risk, if these questions were not there, we could envisage an even higher rating for South Korea. At the other end of the spectrum, geopolitical risk is, so for South Korea, we qualify it as moderate plus, and we used to have a moderate minus. So that's notching up. It really reflects what we have seen. We have a high political risk for Pakistan, where there we think there's a high probability and very high impact of, again, tensions conducive to political instability in the country, serious then strains on the balance of payment, and there with much less capacity to absorb that shock than in Korea. So across the board, we do that assessment. And globally, we do see these pockets of geopolitical risk. Beside Korea, it would be at the moment in the Gulf, around Qatar and the dispute between Qatar and its neighbors, largely, I think, and still some risk around Russia and the Baltics, and a low probability in that case, but potentially high impact of escalation of tensions.
All right, I'm going to ask the last question now, Carlos. Which regions in APEC stand to lose the most from global protectionism?
So in a way, the region has actually benefited the most from the increase in global trade that we've seen, and with the pickup in exports that a lot of us will discuss today in our presentations, we've seen how that's translated into a significant pickup in growth in APAC. So if there is a rise in global protectionism, that would of course translate into a big impact for some of the countries that have benefited the most. Whenever I get asked this question, Vietnam is the first country that I think of. It's also linked to some of the supply chain risks and changes that we've already observed. A lot of, because Vietnam has agreements with so many of its partners in the region, including China through ASEAN, it has managed to attract a significant amount of FDI into the region. Of course, it also helps that Vietnam has about 80 million people. Germany has 90 million people in comparison, so it's a very big economy. Labor costs are significantly lower than China. It's $200 per month as opposed to $800 per month. And it's a relatively young, well-educated population. So you can understand why a lot of that investment into manufacturing has shifted into Vietnam, and Vietnam now is a very important trade hub for, in particular, re-exports of goods and components that then fit into the value chain for the rest of Asia. So Vietnam would definitely feel the hit quite significantly. Thailand competes with Vietnam, especially in chemicals and electrical manufacturing. So of course, Thailand would also suffer. And countries that are in general very exposed to either trade or China will also feel that impact. And Korea is a great example of that, with exports accounting for such a large proportion of its GDP.
Okay, well, thank you very much for speaking it to us today. It can't come more timely, especially since the world's two largest economies are meeting, today in this region and, talking about trade. So, it can't come at a better time now. We're just going to have to see what happens out of that meeting today. But thank you very much to our speakers, with David Mann, Chief Economist Asia of Standard Chartered Bank, Ms. Carlos Casanova, Economist of Asia Pacific at Coface, and last but not least, Ms. Marie Diron, the Associate Managing Director at Moody's Investors Service. Thank you, everyone.